Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Energy futures contracts help businesses and investors plan for future prices of commodities like oil and natural gas. These contracts are essential tools for managing risk and making informed decisions in volatile markets. Understanding these tools is key to navigating the always-changing energy sector. The energy market is often unpredictable. Geopolitical events, shifts in supply and demand, and global economic growth all play a big part in price movements. We'll explore these influences and give you a clear outlook for oil, gas, and energy in this video. Global economic trends and their impact on energy demand. Understanding the bigger picture of the global economy is crucial when we talk about energy. Economic growth or slowdown directly impacts how much oil, natural gas, and other energy sources the world consumes. As economies expand, so does the need for fuel to power industries, move goods, and light homes. Conversely, economic contractions often lead to reduced energy demand as activity slows. We're seeing significant economic shifts in various regions, each with projected energy consumption patterns that hold real implications for energy futures. Emerging markets and industrial consumption. Industrial expansion and a growing urban population in developing economies are major drivers of increased energy demand. As these nations build more infrastructure, factories, and homes, they require substantial amounts of energy. This growth fuels a continuous need for oil, natural gas, and electricity. It is about more than just population. It is about the fundamental transformation of these societies. Consider some key emerging markets and their roles. China. While its growth rate has moderated, China remains a colossal consumer of energy. Its ongoing urbanization pushes housing and transportation demands, while manufacturing still requires significant power. India. This country is experiencing rapid industrialization and population growth. India's energy needs are steadily climbing as its economy expands and more people move from rural areas to cities. Southeast Asian nations. Countries like Vietnam, Indonesia, and the Philippines are seeing substantial economic development. Their growing middle classes and expanding manufacturing sectors contribute to a significant uptick in regional energy consumption. These regions will continue to be central to global energy demand. Their development trajectories directly influence the overall energy market. Inflation, interest rates, and consumer spending. Macroeconomic factors like inflation and interest rates have a clear impact on how consumers behave. These factors dictate how much disposable income people have and, consequently, how they spend it. When inflation rises, everything costs more. This includes essentials like food and housing, leaving less money for things like travel or leisure activities. Here is how these factors influence energy use. Higher inflation. When inflation goes up, the cost of gasoline and heating fuels also tends to rise. Consumers become more conscious of prices and might reduce non-essential travel or turn down their thermostats to save money. This can lead to a dip in demand for specific refined products. Increased interest rates. Higher interest rates make borrowing money more expensive. This affects big purchases like cars or homes and can slow down overall economic activity. Businesses might postpone expansion projects, which reduces industrial energy use. Consumers may also cut back on discretionary spending, further impacting travel and related energy consumption. These economic pressures could collectively lead to lower demand for gasoline, as fewer people take road trips, and for heating fuels, as households become more energy conservative. The interplay between these macroeconomic forces and daily consumer decisions is a critical component in forecasting energy futures. Supply dynamics, production, policy, and geopolitical risks. Understanding the supply side of energy is just as important as knowing about demand. How much oil and gas are being produced, who is producing it, and what global events might affect its flow all play a critical role. Let's look at the key factors shaping energy supply. OPEC Plus strategies and oil production levels. OPEC Plus, a group of major oil-producing countries, consistently influences global oil prices. Their decisions on how much oil to pump can cause significant shifts in the market. In this video, we expect ongoing discussions about production quotas. These talks often involve a tricky balance between maximizing revenue for member countries and maintaining market stability. Several factors complicate these decisions. Internal dynamics. Different OPEC Plus members have varying production capacities and economic needs. Countries like Saudi Arabia and Russia, the unofficial leaders, often steer the conversation. However, smaller producers also have a say and their own interests to protect. Market share versus price. Some members favor higher production to maintain market share, even if it means slightly lower prices. Others prefer to restrict supply to push prices higher, betting on strong demand. This creates internal friction. Non-OPEC Plus production. The rise of oil production outside of the cartel, like U.S. shale, means OPEC Plus cannot control the market as easily as it once could. They must consider how their actions will be undermined by others. Any significant change in OPEC Plus policy, such as deeper production cuts or a surprise increase, would quickly affect global oil prices. It is a constant chess match with high stakes. Shale oil and gas production in North America. Shale oil and gas production in the United States and Canada has fundamentally reshaped global energy markets. This relatively new industry has made North America a major energy producer. We need to consider its health going forward. Here's what we are seeing. Drilling efficiency. Companies have become incredibly efficient at extracting oil and gas from shale formations. New technologies allow for more production with fewer new wells. This efficiency helps keep costs down and output high. Capital expenditure. The amount of money companies invest in new drilling projects directly impacts future production. Higher oil prices generally encourage more investment, while lower prices can lead to cutbacks. We are watching for signs of how much capital companies are willing to deploy. Environmental regulations. Both the US and Canadian governments are increasingly focused on environmental protection. New regulations could affect drilling permits, operational costs, or even limit the expansion of some projects. This adds another layer of complexity for producers. While North American shale has proven resilient, its growth trajectory is not guaranteed. It faces both economic and regulatory headwinds that could impact its output. Geopolitical flashpoints and supply chain disruptions. Global energy markets are highly sensitive to geopolitical tensions. Conflicts or instability in key regions can quickly disrupt supply routes or damage production facilities. This often leads to immediate price spikes and increased market volatility. Let us consider some concrete examples of these risks. Middle East instability. The Middle East remains a crucial region for oil production in transit. Conflicts or heightened tensions in areas like the Persian Gulf or the Red Sea can threaten tanker traffic. Disruptions there can affect a significant portion of the world's oil supply. Russia-Ukraine conflict. The ongoing conflict continues to affect natural gas supplies to Europe and influences global oil markets. Any escalation or new sanctions could cause further shifts in energy trade flows. This forces countries to find new suppliers or routes. Shipping lane security. Major shipping lanes, such as the Suez Canal or the Strait of Malacca, are vital for transporting oil and liquefied natural gas. Piracy, political instability, or blockades in these areas could delay shipments and drive up transportation costs. This directly impacts prices for consumers and businesses alike. These geopolitical risks are not just theoretical. They are real concerns that energy traders and policymakers constantly monitor. They remind us how interconnected global energy supply chains truly are. The evolving landscape of renewable energy and energy transition. As we look ahead, the energy world is changing fast. We are seeing a major shift away from fossil fuels and toward greener options. This move affects everything from how we power our homes to how industries operate. It also has big implications for the future prices of oil and natural gas, even if those fuels are still needed in the short term. Let's explore how this transition is shaping up. Growth of solar, wind, and battery storage. Solar, wind, and battery storage technologies are expanding rapidly. This growth is driven by several factors. Governments around the world are offering incentives to boost renewable energy projects. Think tax credits, grants, and favorable regulations. These policies make it easier and more attractive for companies to invest in clean energy. Technological advancements also play a big part. Solar panels are becoming more efficient at converting sunlight into electricity. Wind turbines are getting larger and more powerful. Battery storage systems are improving in capacity and lifespan, allowing us to store renewable energy for when the sun isn't shining or the wind isn't blowing. Perhaps most importantly, the costs of these technologies are dropping. It is now often cheaper to build new solar or wind farms than traditional power plants. This makes renewables highly competitive, helping them gain a larger share of the energy market. Their consistent growth means we'll depend less on traditional fuels over time. That's the foundation of the energy outlook, understanding how oil and gas still drive the market while renewables steadily rise. But what challenges and opportunities lie ahead? Stay tuned for part 2. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.